In this advanced how-to session, I want to talk to you about all of the sophisticated cash flow variables that any good cash flow management and property portfolio planning tool should have. So let's start from the top in terms of cash flow management. Naturally, we need to do our budget, and then we need to assume that the value of that money is going to increase over time. We call that indexating. Now, what happens with indexation is 3%. That's the figure that we use in terms of wages growing at 3% and also costs growing at 3%. So that's number one. Number two, we're also then looking at interest rates. So obviously the cost of money is influenced in terms of how we borrow money and the cost we have to pay that back. So in any good sophisticated modelling tool, you should assume a higher variable. So we're talking in our models, we use 7.25%. So even though interest rates are a lot lower at the moment, it's important to understand that you can afford it not only today, but into the future. Now, when we start to get into the property side of things, we need to start looking at the variables associated with the property. So acquisition costs. Now, anything under $750,000, a good rule of thumb is 5% to acquire that property is going to be your cost base. Anything above 750 to say 1.2 million, start to use 6%. Anything above 1.2 million, you're probably at around 6.5 to 7% if you're getting up to the $2 million acquisition stages. So that's the cost of acquiring the property. The next phase we need to look at is, okay, what about occupancy rates? What's an appropriate occupancy rate? Well, we're conservative, so we use 92%, which effectively reflects 4 weeks of every year that the property is going to be vacant. And we think that's quite conservative. What about the ongoing holding costs? Well, the ongoing holding costs, we use 1.5% of the value of the property, indexing at 3% per annum. So you work out the value of the property, you add 1.5%. Now, what should that cover? That should cover things like rates, maintenance, holding costs, body corporates as well. Now, it's really important if you do get a property that's got high body corporates that you adjust for that. But you really want to focus in on trying to get the holding costs as low as possible, because at the end of the day, you don't want your rent, which is really the passive income that we want to live on, to be really just servicing the costs of holding that property. The other area is property management. Now, property management fees vary around Australia, as low as say 5 to 5.5%, including GST, right up to around 10% when it comes to looking at Western Australia as an example. Now, we use 7.7 to 8.8% depending on which state or area that we're looking in. So it's really important to understand that. Now, they're the main variables. The other thing you also need to factor in is don't just look at your property portfolio in isolation. At the end of the day, it's part of the overall wealth building strategy that you do. So although we don't advise on superannuation and other investments, we do want to factor in some growth rates and also some income that's coming from that. So as a rough rule of thumb, we use 6% growth rates for superannuation, and then depending on the type of investment strategy you might have with your managed funds, you need to decide what sort of growth rate and what sort of income rate you want to put into your models. So they're the moving parts associated with all the variables, and we're talking about a very sophisticated model here in trying to understand future value and bringing that back into net present value. So it's really complex. It's not going to be an easy model to build, but we are in the advanced how-to session here, and that's why I wanted to share that. So if you want to build out these sophisticated models, that is a great place to start. Thanks for watching.